Today I'm going to be talking about the 7 new funds released by Simplicity KiwiSaver. So Simplicity is probably most well known for their KiwiSaver products. In fact, they're probably one of the most well-known KiwiSaver providers in New Zealand, having won the CanStar Most Satisfied Customers for KiwiSaver multiple years, even though I am not entirely sure what exactly CanStar is good for, really, apart from just having these financial institutions pat themselves on the back, but that's a whole different topic. So let's go into these funds individually by itself. So we have the KiwiSaver High Growth Fund, the KiwiSaver Defensive Fund, and the 2 corresponding High Growth Investment Fund, and the corresponding to the KiwiSaver Defensive Investment Fund. They have also released 3 new Global Share and Bonds Fund, which are the Hedged Global Share Fund, the unhedged version of that fund, and the Hedged Global Bond Fund. So let's go and look through these one by one. So for the KiwiSaver High Growth Fund, this fund is mainly invested in growth assets, and it's similar to an aggressive fund, like some of the funds that are provided by other KiwiSaver companies. Their fees are 0.29% for their management fee, and they have allocated 98% of the distribution into growth assets, with 73% in international, 15% in New Zealand shares. So pretty much all of it is in the growth assets for this high growth fund. Many of the people that are currently with Simplicity KiwiSaver will probably ask, what exactly is the difference between the growth fund and the high growth fund? So for their growth fund, the fund has 80% in growth assets and 20% in income assets. So for the high growth, you basically have close to 100% in growth assets, whereas with the growth fund, you're probably getting a 80-20 split. On the other hand, with their defensive fund is pretty much completely the opposite way around. So in terms of fees, it's still 0.29% in terms of the fees for KiwiSaver. And their defensive fund has pretty much all of their investments in income assets, with 95% in income assets, which includes fixed interest and some international fixed interest. So how does their defensive fund differ from their conservative fund? So for their conservative fund, they still have around 20% in growth assets and 77% in income assets. So pretty much this is the flip of the growth and high growth fund. So if you're looking for pretty much income generating assets, for the short term, defensive fund may be an option for you. If you are interested in using those funds as an investment fund, you could do that as well. So the high growth fund also exists as an investment fund, and the same with the KiwiSaver Defensive Fund. It also exists as an investment fund by itself that you can invest into. So you have the KiwiSaver on one side, and then you have the investment fund on the other side. The 2 are the same product essentially, but one is for KiwiSaver, one is for investment fund specifically. Now let's take a look at their other new product. So it's also 3 investment funds. So you have the Unhedged Global Shares Fund. So for the Global Shares Fund, they have a fee of 0.15%. So it's a little bit lower than the high growth investment funds that they have on offer. So if we look into what's exactly in the fund, it's 100% in terms of international shares for the hedged and unhedged investment funds. And this basically follows the ESG index from Bloomberg. Now you might ask, what exactly is different with this hedged or unhedged version of this investment fund from the high growth fund that they newly have on offer? So I had a quick look. So basically with the high growth fund that they have on offer, they invest in more companies. So it says that they have 4,000 investments in more than 20 countries. as compared to the Global Shares Fund, which invests in 1,400 different investments in more than 20 countries. Basically, I don't see a huge difference between the two, because investing in 1,400 companies and more than 4,000 companies, because each percentage of the companies is so little, it actually really doesn't make a huge amount of difference in terms of diversification, especially considering the highest allocations for these particular funds are usually in the biggest companies itself. So it's not an even distribution between all of these thousands of companies. Usually the highest companies with the largest market cap, such as your Apple, Microsoft, and that kind of companies, gets the highest distribution anyway, so they tend to skew the results or the earnings of these particular funds. So for me personally, investing in 4,000 funds and 1,400 funds, for me personally, doesn't make that much of a difference. So the next question is hedged or unhedged. The hedge version basically means that you are protected against the currency fluctuations, whereas the unhedged version, you are not protected against the currency fluctuation between New Zealand dollars and the US dollars. Both have similar fees at 0.15%. Again, personally, for me, I prefer the unhedged version of a particular investment fund. But if you don't like the fluctuation for a investment fund, you could easily have a 50% split in unhedged and hedged. Or if you just don't want to deal with currency fluctuation at all, you can go 100% into the fully hedged version. Again, it's all up to you. All right, the Global Bond Fund, same fees, 0.15%, and this one is invested in 2,700 investments in terms of fixed interest in more than 20 countries. So if you want to invest in some bonds just as protection against your portfolio, you could easily do that as well. But again, with these rising interest rates, which means that bond investments could potentially drop lower in value, it's just something that you have to pay attention to. Overall, which fund would I be personally interested in? I mean, if you have an extremely long retirement time frame, if you have like 40 years, 50 years till retirement, you could potentially switch over to a high growth fund to maximize the potential returns over that long period of time. If you have less than 5 years to retirement, potentially you could switch over to the defensive fund. In terms of their new global share fund, the one that could potentially be interested in is their unhedged global shares fund. The main reason is that it's got a lower management fee of 0.15%. Now, one of the things that I really want to know is I wish they would have a chart showing the returns of the particular index from Bloomberg, like even over the last couple years of time wherever the index was released. So please, simplicity, give us the chart for the past results for this particular index.